Our webinar today, The High Price of Exposure, What You Don't Know About State and Local Tax, presented by Jason today. Just a few little housekeeping items. There will be a survey at the end. You must take this survey in order to receive your 1 CPE credit. It's just letting us know the good, the bad, the ugly of the presentation, but I assure you Jason will take care of you this afternoon. Please expect your CPE certification certificates within a week after the webinar. We are using a new platform through Simple Cert, so you will see an email come through and then a download link. This should be a little faster than we have done in the past when giving out the certifications, so just look for that. And do not unsubscribe from Simple Cert, or else you will not receive our certifications coming through to your email that you have registered with today. Throughout the presentation, we have our polling questions. We must get to 85% participation on these in order for Jason to move along with the information. Just make sure you guys aren't falling asleep on us, which we hope that you will not, because Jason has a lot of interesting information. So with that, I will pass it over to Jen Nelson, who's going to introduce Jason.
Good afternoon, everybody. My name is Jen Nelson, and I am the tax director and a tax principal here at Stanbaugh Ness. I just wanted to give a brief introduction before Jason started talking about Jason's role in the firm. Jason is a manager here in our tax department. He has been with the firm for about 6 years and works mostly on your multi-state, larger engagements, but he is a jack of all trades and can answer a lot of tax questions when we need him to. So with that being said, I'm going to turn it over to Jason now. Before I do that, though, I just wanted to let you know, as questions come in, we will be taking a look at them on the screen. If we can answer them, we will. If not, we will definitely get answers to you as soon as possible. So with that being said, go ahead, Jason.
Thanks, Jen. So we got a jam-packed agenda today. We're going to start with some current state and local tax trends. We're going to move into some Nexus and some new developments in Nexus. We're going to talk a little bit about sales and use taxes. Talk about unclaimed property and property taxes, some income and franchise taxes, you know, the ones we all know about, and there are some pretty significant changes and things happening, so we'll talk about those. Then we'll end with some, hopefully, good news and some state tax credits and incentives. So we're going to start with a polling question. So, which industry does your company currently operate in? Is our first polling question. We in professional services, which includes, you know, your architects, engineers, attorneys, and accountants, construction, manufacturing, technology, or other. So it should have popped up on your screen, and I have to wait till we get to 85.
All right, so we have 59% professional services, 14% construction, 13% manufacturing, 2% technology, and 13% other.
Cool. Thanks. So we're going to dive right into current state and local tax trends, and basically, why is this important? What's going on? So, as we know, I think we're well aware of our debt and unfunded retirement costs. So unfunded pension benefits are the largest, most prominent and fastest growing of future costs. Our state Medicaid spending is growing in all, it's growing in all 50 states. It's actually the state's second biggest expense after K-12 education, so that definitely plays into what's going on. There's heavy reliance on federal revenue for the states. Again, that's actually the second largest revenue piece for the states. So we're pretty much all well aware of what's going on in Washington. So the federal budget decisions and everything going on down there definitely plays a role in our state budgets. So state governments have a strong desire to reduce the tax burden on in-state sources, basically their voters, while increasing revenues in other ways. They want to drive the revenues up, but they don't want the people who are voting them into office to be the ones that pay the burden. So what they're doing, they're looking for other ways out there. They're looking for out-of-state businesses. When allocating income to the states, the importance of the sales factor is increasing as physical presence is not necessary to operate businesses anymore. We're moving on to the internet, we're moving into the cloud, things like that. It's helping us, not have to physically be at places to provide services, to do various things. So states are quickly making a move away from, all your income being reported in one state to pieces being reported all over the 50 in the U.S. Moving on, our economy has seen an increase in products, projects, and/or employees crossing over state lines in recent years. Technology, as I mentioned, has allowed us to perform services all over the world. Many times, sales and shipments and things are moving to other states with little or no advance notice to people in accounting, to all of us. A lot of times we're just finding out about it after the fact, and we find out, hey, we had some nexus. So, and the other piece of this is internet sales and what's going on out there in the cloud. It's creating complexities, and it's different. We haven't dealt with it, and the states are leaving it to litigation right now. So basically, we have a desire to get in front of state and local taxation. In most companies, tax is a reaction to events that have happened in the past year. And what this does, it kind of ruins what we can do for clients and what we can do as planning. It creates less room for improvement, and it creates less room for us to manage risk if we're just reacting all the time. And most companies have some sort of strategic marketing or even federal tax plan. Very few have a state tax plan or strategy. So we want to strive to manage the tax positions of our clients and your companies instead of allowing it to be created. So we'll move on to the next polling question. A couple quick here at the beginning. So the next polling question is, my company has a federal and state tax plan. Is that true? Is that false? We only have a federal tax plan, or is it false? We don't have a tax plan at all. And again, we're waiting for 85%.
Alrighty, 85. So 55% true, 19% false. We only have a federal plan, and 26% false. We do not have a tax plan.
Interesting. Thanks. So moving on in just our overall SALT overview, the first step in the process is establishing clear indicators that will cause your company to create nexus in a state. The most common that we see are, employees living or operating in a state, salespeople entering a state, performing service in a state, or sales hitting a certain significant level in a state. All things we always got to be thinking about. That leads me right into our next topic of nexus. So we'll get some definitions out of the way quick. So nexus is defined as the minimum connection between the taxing state and the taxpayer, property, transaction, whatever, in order for the state to tax it. As such, nexus requires the state to have sufficient contact with the business it wants to tax. Key note, nexus standards vary depending on the tax. It's very, very possible for us to have nexus for one tax and not the next tax. We'll hit some pieces about how nexus and the states cross over into the U.S. Constitution. So 2 items create that crossover. Of those 2, we're talking about the Commerce Clause and the Due Process Clause, and they're both pretty significant here. The Commerce Clause basically wants to ensure that interstate business can proceed without undue interference from the states. You can cross over state lines and we're not having issues. We're not having hardships. And this is where the requirement that the state has substantial connection with the activity before it can tax it. Then we'll talk on the other side about the Due Process Clause. This is the clause that basically requires the state to have a minimum connection to tax the person, property, or transaction. Again, you can see there exactly what it says in it. It's what makes us keep that minimal connection. And then we'll talk quickly about Quill. Quill's a court case, and it's one that you're going to hear in sales and use tax very, very often. This is where physical presence is. They determine that physical presence is required to collect and remit sales tax. So basically, they said, economic presence doesn't satisfy the Commerce Clause. We'll talk about economic presence in a couple of minutes. But I wanted to point out that Quill has been applied, and because it was a sales and use tax case, most of the states have taken the stance that it's sales and use tax only, period. There's no income tax, there's no gross receipts tax, there's no any kind of tax other than sales and use tax that physical presence itself is required. So for our manufacturers on the line, it's usually the one that this applies to more than anything, but we'll talk about Public Law 86272. And what this does, it sets up 4 criteria that protects those people from income tax. I want to point out, we're talking about on this one, we're talking about income tax, not gross receipts, not minimum taxes, not franchise taxes, not sales or use tax, but we're talking about income taxes. What the protection is given, it's for the presence of employees or other representatives of the company that are only engaged, and it has to be, all 4 of these things have to be covered. If you do any of these 4 things, outside of these 4 things, it doesn't cover it. So those 4 things are, they have to be engaged in solicitation, so you have an issue with the definition of solicitation. They have to be engaged in only sales of tangible personal property. Again, tangible personal property are things. There's a more specific definition out there, but we're talking about things. The orders have to be sent outside the state for acceptance and approval, and shipment or delivery has to happen from a point outside of the state. Again, it creates an opportunity for manufacturers, if they follow all 4 of these things, it keeps them from having it protects them from income tax. What it doesn't protect are the taxes we just discussed. It also really doesn't protect sales of services or intangibles. So, our professional services firms and such on the phone, it's not going to give you protection there. So moving to the meat and potatoes of this part of Nexus. And economic and factor presence nexus. The aggressive states are pushing to tax out-of-state companies to the fullest extent of federal law. They're getting very little pushback from the U.S. Supreme Court. They're not taking cases on this a whole lot. It's getting up to a certain level, and they're stopping. So basically, the states are running free. They're becoming super aggressive. They're doing what they want to do. So economic nexus basically says that no longer is a physical presence needed, just an economic connection to the state. So there are all sorts of examples. We have a ton of states. But, Connecticut, we got Indiana, Iowa, Louisiana, New Jersey. There's examples all over the place. I mean, just for example, in Indiana, in 2008, they basically said, hey, they reaffirmed that Quill, what we talked about earlier, does not go past sales and use tax. So it was a bank case. So the bank had an economic presence, and it was enough to create nexus. So interestingly enough, Texas did the exact opposite and said, there's no difference between sales and use taxes and income taxes, so Quill doesn't really matter. So we have a lot of this out there, and it varies state by state, and it varies because of litigation that's happened in those states. Again, there's been no Supreme Court presence over the top that said, hey, this is what we're going to apply to the land. Most of these cases typically surround the idea of holding companies, holding that have franchises. So the big one is Jeffrey Inc., who is the holding company for Toys R Us, that is they have franchises in all these different states, and they make their money by selling the rights to the trademarks, to the giraffe, to the Toys R Us, that kind of stuff. So basically the states came back and said, why aren't we getting any piece of this? Why is this all going to Delaware? So that's where this all came from, and it's the states getting out of, we don't need physical presence because we as companies don't need physical presence to create income to tax. So this will lead us then to what I see as the next progression in the steps is factor presence nexus. They basically go and say one factor of payroll, property, or sales is over a certain amount, you have nexus. So it makes it a little bit simpler from a compliance standpoint, but it can catch a lot more companies with nexus in those states. So the MTC, the Multi-State Tax Commission, I abbreviated it on here, is an organization of state governments that work with taxpayers to administer tax laws that apply to multi-state organizations. So they came out and said, in 2002, $50,000 of payroll, $50,000 of property, or $500,000 of sales will establish nexus. Or, there's a big or in there, 25% of the company's total property, payroll, or sales, if they're in that state, they have nexus in those states. Now, again, different state by state. As you can see here, we got examples. Alabama, they follow this rule with those amounts. California, different numbers because they're adjusting for inflation every year, but it's at 563,000 some number. So Michigan actually has a lower sales amount, so Michigan's at $350,000 of sales. Nevada has a commerce tax that it's at $4 million. New York is at $1 million in receipts and it creates nexus. Ohio, Tennessee, they're on the same 50, 500,000. Washington is 53,000 of payroll property, but $267,000 of receipts. So again, it creates this. It's easier to manage from a compliance standpoint. It's worse for the companies because you're going to get pulled into more states. Agency and affiliate nexus. Agency nexus mostly centers around sales and use tax. Basically, it answers the question of what happens if the company conducts business in another state through the use of independent contractors rather than its own employees. So you have an independent salesperson. The states are super split on this topic. It's, that creates nexus in this one. Doesn't create nexus in another one. So it's no longer an area that you can just go to and say, hey, we have independent, they're 1099 contractors, that we aren't creating nexus through that. The states definitely are starting to disagree with that stance. We'll talk a little bit about affiliate nexus. Some states have taken the position that common ownership and related activities between a corporation that has a physical presence in the state and out of the state, that has no physical presence in the state, is sufficient to create nexus with the out-of-state affiliate. So we have a company that is an affiliate of another company that has presence in here. They're saying that those related companies, you're creating nexus in the one that doesn't have it currently. Again, highly, highly litigated, differs very state by state due to that litigation. And the last point I wanted to make was just a reminder on here that if you are a C or an S that is a partner in a partnership, that ownership of that partnership that operates in those states creates nexus in those states. So something we definitely got to continue thinking about. So let's talk a little bit, about nexus and planning for it. So clearly it's a complex topic across, different taxes. It's different across taxing jurisdictions. It's different across industries. So, we can perform nexus studies to evaluate where, companies have created nexus and things like that. Many times, nexus can be created, like I said, without accounting or management knowing, by salespeople going into the state and executing contracts. Once we know about nexus, we can take steps to discontinue the nexus creating activity, either through policy. A lot of times we'll talk about creating some policies that keep, salespeople from doing certain things, or changes in structure. So, for example, if maintaining a corporate office in a state creates an undesired nexus, the corporation may be able to avoid nexus by, if it's a sales office, you just provide the sales representative with an office allowance rather than putting an actual company office there. Again, that's going to vary state by state. Some are still going to say you have nexus regardless. You got to be careful. So, depending on the situation, we may want to create nexus in other jurisdictions as well. We may want to get the right to apportion income, which we'll talk about later. We can also, work on voluntary disclosures. If we find out down the road that, we had nexus, this person did this, we're concerned, there's exposure out there. Voluntary disclosure is basically us saying, we're sorry, we messed up. We'll set a period that we go back to that we're going to catch up on. We're going to pay the tax that we owe to our bad. But hopefully, state, you can not make us pay the penalties. It's a nice program. It keeps the state from having to audit everything, but it also gets more revenue in there. It's an avenue we've gone down. So moving into sales and use tax. "45 states and DC impose sales tax on retail sales of tangible personal property and or selected services, and they also impose use tax on the consumption of those items or services." And to further complicate everything, you add in various cities, towns, school districts that have the power to levy sales taxes for their jurisdictions. And estimates have been put at there's getting near 10,000 different sales tax jurisdictions in the United States. Definitely something we need to be considering. All the states impose sales and use tax in a complementary fashion. They're at the same rate. Basically, we should either pay sales tax on those items at the time that we purchased them before the ultimate consumer, or if it's not charged, we should be paying use tax on our consumption. This is nice, for the states, and really it's a requirement under the Commerce Clause to avoid issues with interstate and intrastate commerce, but not necessarily the case for all the municipalities and localities that charge all these different sales taxes. They aren't always the same sales and use tax when you get down to that granular level. So, as companies, we must always be considering and thinking about the rate imposed on various transactions because it can vary wherever we are and whatever we are buying. We definitely need to talk a little bit about intrastate versus interstate sales. Intrastate sales are those within a state from a company within the state. Typically, sales tax applies to these sales, these transactions, and it's collected by the selling company. They remit it off to the state, if we're the ultimate consumer. Interstate sales are those involving multiple states. Use tax usually applies. Basically, on one side, if that company that's selling it from out of state to you in state, if they haven't created nexus through any way, they don't have a requirement to remit use tax to, in our case, Pennsylvania. So if they haven't created nexus, they're not going to collect it. It's on you to remit the use tax if you're the ultimate consumer of those items. Very important pieces of the sales tax calculation in general. So what's the amount that's subject to tax? What percentage should be applied to the tax? What's the selling price or receipts subject to the tax? And are there any exclusions or exemptions from the basis of this tax? The next question we have is, who's responsible for the collection or payment of the tax? The ultimate purpose is for it to be a one-time tax at the consumer level. If the seller has nexus in the state and has a taxable sale, the seller must charge the appropriate sales tax and remit it to the state or obtain documentation supporting a tax-free sale. Again, this documentation is typically a resale or exemption certificate, and we just got to be careful with those because they vary greatly state by state by state. They can be in different forms, and they're really something that under audit you got to kind of cross your T's and dot your I's on. So the next question is, what if the vendor doesn't charge sales tax? Well, we have to track it and pay the use tax in that case. Lots of issues when it comes to sales and use tax. Basically, what's subject to tax? What are they? Differences among the states due to various politics and economies in those states in each of those jurisdictions. These are pretty quickly expanding to include services as our economy is, moving to a much more service-based economy. Recent issue that's been dealt with is, who gets the tax? Which state gets the tax on sales between the origin and the destination state? If you have an interstate sale, who gets the tax? The one that it originated from, or the one that who ended up being the consumer? So this varies again among the states. But we certainly, you got to know so that we can tax it appropriately. The price, definitely something else that we got to talk about with sales and use tax. Tax is typically imposed on the entire sales price. You got an issue of, coupons, rebates, discounts, so on and so forth. typically, and again, as I say these typically things, this is state by state by state by state and trends and things like that. But, manufacturer coupons usually don't reduce the sales tax. But cash discounts are typically excluded from the sales tax. Again, varies state by state by state. More issues. We have, Nexus, as we talked about before. Quill applies. Physical presence is typically needed to collect sales tax. You have click-through Nexus, which, a seller will be presumed to be making a taxable sale if that seller enters into an agreement with a resident under which the resident refers potential buyers by link, typically on the internet, click-through, or, an in-person oral presentation to the seller. This creates Nexus in most cases. And then the other thing I wanted to mention was the Marketplace Fairness Act. It's proposed legislation in the U.S. Congress that would enable state governments to collect sales and use taxes from remote retailers with no physical presence in the state. It's throwing out Quill. Originally, it was passed by the Senate in 2013. I think it's been back and forth a little bit. But of course, it's hugely supported in Congress and state governments. Another thing we wanted to talk about was disregarded entities. They're disregarded for federal tax purposes, but they're not necessarily disregarded for state tax purposes. We can have, sales and use tax, property taxes that you got to pay on those. So we got to be careful with those. And many industries have special rules, rates, etc. Many of those, that are on the line today. Manufacturing has their own set of rules. Construction does. Technology does, and they really especially do when you're selling software bundled with service agreements. So what can we do to deal with this web of sales and use tax, this mess of sales and use tax that we have all these different states? Well, we can take a look at service lines and create a taxability matrix. You look at all the revenue lines and what is not taxable and what's it taxed and what tax rate is it at. You can create decision trees to help, that decision-making process of to tax something or to not tax something or to pay use tax on. You can certainly do a nexus study to figure out where you have sales tax nexus. And once you do that, you can do an exposure calc. You can figure out what your exposure is to see what to see what you have. And in the end, that exposure calculation is you have nexus, but it's a cost-benefit analysis. It's can I limit the amount that I'm worried about by paying a couple bucks and getting registered and filing these. It's a personal decision. Again, at that point, you can do voluntary disclosures. We're sorry, we messed up. Here's your tax. Here's your interest. No penalties, hopefully. And then we can register for this and to start filing too. So, in audits, we can. A lot of us have been through audits. They're not fun. They're time-consuming. They're expensive. But the best defense against these sales tax audits is a good offense. You can do a policies and procedures review to manage your risk. As I said, it's time-consuming and expensive. We can provide, through inquiry and review of procedures, some suggestions on how to increase your transparency and communication in the sales tax arena. I just wanted to say, remember, negligence penalties in some of these range from 10 to 25% of tax. So it could be a big number. There's definitely some opportunities for automation or getting technology more involved to take some of the burden off of your people. We could definitely be involved in pre-audit negotiations. These can range from sampling methods to audit timing to coaching as to how to speak with auditors. And I just wanted to throw a reminder out there that our statute of limitations is what we fall back on. You got 3 years from the time you filed your return or so on and so forth. But that doesn't start if no return's ever filed. So some of the states can go back and as far as they've determined that you have nexus and you had a connection to that state and say, you need to pay, you got to come forward. And you can have a decent amount of exposure due to that. If you're audited, it's the perfect time to perform a reverse sales tax audit. The reverse sales tax audit is intended to identify areas of overpayment which the auditor's not going to necessarily be looking for. So it's shown out in statistics that taxpayers are as likely to overpay sales tax as they are to underpay sales tax. So it creates an opportunity also when you get that that number back at the end of the audit that you owe that you didn't pay in because something wasn't paid right. It creates an opportunity to offset that a little bit with whatever you find that's overpaid. So that's definitely an option. Early on in an audit, you may want to perform a self-audit. Before they get in, start to figure out what your exposure is. And this would, be figuring out where you don't have exemption certificates and where you failed to self-assess use tax on capital or expense purchases. Find those things out. If you can, deal with them now. Deal with them soon. Kind of like I stated before, the burden of proof here is on the taxpayer and not the auditor. So the taxpayer, must retain appropriate records. Also, with that, there's a side of that you don't want to keep untimely records. You want to destroy them in a timely fashion, because if nothing's available, typically an acceptable compromise with the authorities will be worked out. Another thing I wanted to mention, and it kind of comes back to our salespeople and doing their stuff, is if you receive a Nexus questionnaire, please reach out and have somebody review that understands what they're looking for, because we're trying to avoid Nexus if at all possible. If there's some misunderstanding or if there's some confusion and questioning on the Nexus survey, it's probably made that way, A. And B, we should probably make some sort of internal policy as to what's going on with these Nexus questionnaires. If salespeople get them, they come back to accounting and we deal with them, as opposed to typically what happens a lot of times is your salesperson will get it and it'll become, hey, I do this, I do this, I do this, I do this, and a lot of times not necessarily the case. So we want to be careful with those. The other thing I wanted to talk about too was just sampling methodologies in a sales tax audit. When you're sampling something, there's so many different ways to get it messed up. Most states don't use a verifiable sampling method in the majority of their audits. The results can be super biased and therefore not representative of the population or sampled, right? The sampling concepts can be extremely complicated, which makes them vulnerable to the state's errors. Sampling is frequently applied to transactions that aren't appropriate for sampling, such as large fixed asset additions. Sampling sizes are typically not determined using any precise method of calculations. So states routinely oversample and undersample taxpayer transactions. So the moral of the story is, let's have a discussion, because that's one of those things that you talk about in those pre-audit negotiations is how they're going to sample it. Let's see if we can talk about it, get it dealt with ahead of time. So here's where we talk about. I just want to point out here that public opinion polls have indicated sales and use tax as the preferred tax. They want the consumption taxed. They don't want their income that they take home taxed. And with all the pushback on all of our lawmakers and everything on income taxes and not having them budge or potentially going down, sales and use tax is going to be a growing area. So on to the next polling question. The polling question is, my company has been through a sales tax audit in the past 5 years.
All right, so we have 26% true, 63% false, and 12% I'm not sure.
Cool. I just wanted to comment on some of the questions that were getting put through. A lot of them are very specific, and about home offices with employees working remotely, with doing projects in this state versus this state. And what I can tell you is, without getting super specific, from state and local tax perspective, you're going to hear it depends a lot. And it all depends on the mixture of the states. Like I said, I can't say for specific, like with that example of working in one state, all the work's done here, but it's for a project over here, or what it is. Nexus is usually created through activities. If you have Nexus, then yeah, we have a market base, which we'll talk about eventually. If you have Nexus, there are activities that create it. I don't know necessarily if just, a lot of times just depending on the states, just creating Nexus. If it's not a factor-based state, then you might not have any Nexus. So it really depends, and that's kind of where this whole thing comes is that it's so intermingled and abstract in all the different ways these states deal with it. We have 50 different ones. They all deal with it differently. No one's exactly the same. So I will say that it depends, and that's what you're going to hear, and it all depends on that mix of the states. All right, moving on to unclaimed property. This is a growing area states are looking to add additional revenue. Most states, probably not rightfully so, treat unclaimed property as revenue in their budgets. Even though it's not theirs, it actually belongs to whoever has not claimed it yet. Examples of unclaimed property are uncashed payroll or vendor checks, unapplied AR credits, unused gift certificates, abandoned safe deposit box contents, et cetera, et cetera, et cetera. Things that have been abandoned. Every state in DC has unclaimed or abandoned property laws. This is an area that's going to become more important. Income taxes are hugely debatable. They're a hot button topic every election and everything that goes on. But these are the ones that kind of go under the radar, and they're going to grow in audit scrutiny and going forward. So Delaware, with unclaimed property. They are the aggressive leader of the states, mostly due to the number of the holding companies they have located there and wanting to increase their tax base, like every state wants to. And as I said, many states are going to follow their lead on this. What Delaware is doing, and it's going to seem super aggressive, I'll remind you, it is highly litigated right now, and because it's new and they're pushing their boundaries, it's going to court, but that can mean a lot of cash out your pocket if it ends up being that what they're doing. So what they're doing is they're going out, they're hiring contract auditors, so they're hiring CPAs, they're hiring others to audit companies for unclaimed property. They're estimating the liability on that unclaimed property through that audit for years without records available, and in a few cases they've gone over 20 years with that estimate. A little excessive. And the other piece that they're doing is they're claiming all of the liability as Delaware unclaimed property. So, like I said, a whole lot of litigation's coming on this. It's out there. It's hitting. We're getting it every so often. So, definitely an area to continue to watch. What can we do with this in this area? We help with compliance. We're making sure we're turning over the right items to the states. We can come up with policies and procedures to make sure we're doing that. Because what we don't want to have happen is them come in with an audit and us have to have cash that we thought was ours the entire time. They say, that's ours. So definitely something we need to consider going forward. Moving on to property tax. Property tax tends to be the largest of the state and local tax burdens, but it's typically the least talked about. I think we are very much so just at the point where we kind of take it and accept it for what it is. That's our assessment. Unless it seems super out of the ordinary, we'll just pay it. It is what it is. But there is recourse if we think we're being charged too much for personal or real property taxes. We can limit these strategically depending on the situation. In this arena, we can help with verification of asset records or classifications. Perfect example, classifications on the Maryland personal property tax return is imperative for the tax base. We can help with that classification or some coaching and get it up to where everybody else can do it. Consulting on appropriate property tax values on a tangible personal or real property. And we can also do evaluation of property tax assessments and challenging those assessments where necessary. So to the big one. income and franchise taxes. So I just want to talk about the overall calculation so we can see how all these things, when we talk about them, fit in, right? So our starting point is federal taxable income most of the time. There are some states that's not necessarily the case. It reconciles out the federal taxable income, and the reason I'm saying that is because Pennsylvania is one of those. Not necessarily the case, but in almost all cases, that's where we start. Federal taxable income of one state, one spot. Add and subtract any state adjustments for various things that we'll get to, gets you to adjusted state income. You multiply an apportionment percentage to get your state taxable income, the actual piece that they can tax. Multiply that by a state tax rate, get your state tax, your cash out of your pocket. So we've got plans and strategies to make that starting point right. We got it, we're going to get federal taxable income as low as possible if that's the strategy. It's the other ones. The other ones are the big ones. So state adjustments, got to make sure we're right on those. Apportionments, we're going to spend a huge amount of time because that's the big one. If you had a 100% apportionment, you're going to get taxed on, whatever your adjusted state income is. But fluctuations in that apportionment number can really drive things. And the state tax rate, we don't have a whole lot of control of. So moving on, state adjustments. What you're going to see typically are depreciation. So all these states came out when we increased bonus depreciation, when we increased Section 179. All the states came out and said, yeah, we're going to follow that. Oh, we're not going to follow it after this year, after this adjustment, after this. So different rules across the board. Some do bonus, some don't do bonus. Some have crazy calculations like Pennsylvania to calculate bonus on C corporations. Some have 179 limited to 25,000. Some accept federal amounts. Moral of the story, it's all over the place. And because of this difference that we see, gains and losses can be different when you sell those assets. You also have differences for state tax deductions taken on the federal return. You subtract them on the federal return, they're not going to let you subtract them for the states. And that varies state by state which taxes are deductible and which aren't. Net operating losses can be pre-post apportionment. You have different rules there. And Section 189 or domestic production activities deduction, that's also one that states have adjustments to typically. So when we're group filing, I just want to point this out. I want to make sure we're remembering this in the back of our heads. Consolidated returns. Again, another issue that states are all over the place on. So one state's going to say, if you file federal consolidated, you have to file state consolidated. One state's going to say, like Pennsylvania, for example, yeah, you filed federal consolidated, we don't care. You need to file the returns in Pennsylvania that have have nexus in Pennsylvania, and those are it. So, and then there's some that you have an election you can make. There's some that you can do it. There's other ones that don't let you do it. It's all over the place. So we've got to be careful when we're talking about consolidated returns. There's also a topic of unitary business that we can talk about. It's the idea that we can tax a business enterprise whose operation spans multiple states, all the activities that constitute a single trade or business. They basically say they got to be viewed as a whole. It's a whole entity. It's unitary. And like I said, takeaway here is we got to be careful with related entities. They can create issues with where and how to file. Again, meat and potatoes of this part of state and local, income franchise tax is apportionment. So I can't skip right to apportionment without talking about business versus non-business income and apportionable versus allocable income. So for businesses, business income, that's your core service. That's what you're doing, and yeah, it might be 15 different lines and whatnot, but that's business income. That's all apportionable. That we're going to take and apply a percentage to, and it's going to go to this state. Non-business income, if you have investments out there that you have dividends or interest or things like that on, that's going to be allocable. That's going to go state by state by state by state. You can pretty much say that applies here, that applies here, that applies here, that applies here. So our old school formula, what originally came out, what most of them had and what most of them were moving away from, was this three-factor formula. We're moving into apportionment now, sorry. And what that is it's basically three equally weighted proportions that in the end, are worth a third of apportionment. So you have a property, which is, we'll talk about down there. You have property, payroll, sales. Over the years, they've continued to increase the sales percentage. So a lot of the states years ago went to double weighting the sales factor. And then some went to more and more and more and more until basically some of these states just said, why are we doing this? Let's just move and go right to the sales factor. So a lot of states are moving to single sales factor apportionment. Just a note here that we want to make sure that we create the right to apportion income, which is what I was talking about at Nexus, and that standard varies state by state. Those formulas can also be industry specific. Example that I typically use is trucking companies and things like that. They can split by miles in each state as opposed to any other factor because it's probably most relevant. But when we're talking property factor is typically the average cost of the property owned plus rented property times 8. So when you talk about factor, it's a proportion. So it's the amount in state A out of the total equals this percentage. And then payroll factor is payroll to in-state employees out of the total. So again, it's in this state out of total, this percentage. Then we get to sales, same deal, and then you have those 3 percentages, and you get your average percent. That's your apportionment. That's what you got to pay tax on. That's what you apply to get to your state taxable income. So we got states are all moving to single sales factor apportionment. Sorry. Some of these, as you can see, are elections. Some of them are industry specific. 2 of them are going there in 16. One of them's Delaware, who's headed there in 20, is going to phase it in, so it's going to be a little different. North Carolina's heading there in 18. We got industry specific ones all over the place. So as you can see, it's a pretty big list. It's 20, 30 states that are headed there, and more are going. It's 3 or 4 or 5 every single year, so it's fairly interesting. So we'll hit up the sales factor. And basically that's, when I talk about sourcing sales, that's what goes where. Sales of tangible personal property, which are, manufacturers, retailers, things like that. For years, they've been based on destination. And that's where it is. It's where that ultimate usage of that property is where it should be apportioned to. Who gets credit for that state? A lot of times, if you're selling it to a warehouse here and it gets split out to 100 different places, that's really tough to determine. But that is what it is. Dock sales. Most of the time, the states are saying, it doesn't matter how it got there, whether it was common carrier or your trucks. The sourcing of this belongs in our state since it was delivered to the end consumer in our state. So the intermingling of the factor and apportionment and nexus applies here. So we can avoid nexus in that state if we're shipping third party. If we're shipping common carrier, typically, we're not, as long as we're managing what we're doing, we're not going to create nexus, so we don't have to pay sales in that state, we don't have to pay tax in that state. But if we create a nexus through some other activity, then we've got to figure out where those destinations are, where we're sending those things, where the ultimate destination is. Another area we can get caught up on is throwback rules. So Pennsylvania has no throwback rules, so it creates an opportunity for C corporations to basically get rid of a lot of sales that go to states they're not taxable in. And like I said, you have a proportion, so it's in your state over the total. So the throwback rules for a state like Alabama has a rule where they say, you know what, if you don't sell, if this is being delivered from Alabama position to another state where you're not taxable or to the federal government that's not taxable, that number comes back into Alabama, so we can collect tax on that. So it's something that we got to think about. We'll get away from the manufacturers, the retailers, and that kind of stuff. We'll head into sales other than sales of tangible personal property. In historically, we've focused on the cost of performance of this work. If the income-producing activity is performed in the state, it goes into the state. If the income-producing activity is performed both inside and outside the state, there's multiple different ways that they split this on cost of performance. Now, I say historically, cost of performance is still around. We'll see that in a little bit. But so we'll just understand that it's complex because now you got to determine where the costs of creating this revenue are, how to track that. That's a difficult thing to do. So, like I said, it focuses on efforts of the employees rather than the actual customer location. Services were always typically sourced to a single state wherever it was being done, wherever the performance was. So as we've been talking about, we're changing to a service-based economy. So this is where market-based sourcing came from. They said that doesn't make any sense. Why do we care where it was performed? Why don't we care more about who's getting the benefit of services or who's getting the benefit of intangibles? It's destination-based. It's, where is that being delivered and things like that. So why? It creates a more accurate picture of your tax base. It says, you know what I mean? It's whatever my state is getting, if I'm sitting here as the state of Pennsylvania, it's who's getting the benefit of services in my state. That's what I'm taxing. Cost performance outweighs home state sales factor. If I'm a Pennsylvania engineer and I'm doing a lot of work in my office, there's going to be, if we are cost performance, which for C corporations we're not, we're going to have a ton put into our home state. Our apportionment's going to be very high for our home state. Does it make a lot of sense? Maybe, maybe not. But there's also, as I was talking about, there's administrative burdens to determine the cost of performance components. So and I'll talk about this when I get to the map in the next page, but there's different ways to calculate that. The other thing we got to think about with market-based sourcing is there's throw-out rules. So that's kind of the opposite of throwback rules. So with throw-out rules, some states, again, Pennsylvania not being one, they basically say if you're not taxable on these sales, you need to take that out of the denominator of that fraction. So either way, it drives up your factor because you're removing something from the denominator. Definitely something to consider. And the differences in market-based sourcing comes in the definition from state to state to state of market. So as you can see here in our breakout, some define it as where the benefits received. Some define it as where the service is received. Some define it as where the service is delivered. Some define it simply as where the customer is located. Different across the different states, and it varies. It's definitely something we need to consider for all of our states, for all of our companies as well. Sourcing of sales. This just shows how complicated this is. So the blue states are the cost performance or proportionate states. And this was as of the middle of 2016, so it's not fully updated yet. Cost performance proportionate states. So we have 3 states that are 33% each, right? 33% of that sale, when I say 33% each, the costs are performed, 33% of the costs are in each of those states. So 33% of the sales will go to each state in our sourcing. The all or nothing method is, do we have a majority? It either all goes here or none goes there. So if we have one that's 70% and one that's 30%, the one that has 70% of the cost is going to go there. The really confusing part is when you have an intermixing of states that you're working with that are the all or nothing one, you got proportionate over here, you've got market-based here, all these different ones, and then market-based all defines their stuff differently. So they can come in and say, hey, you can be double taxed on things. It's all over the place. And then market-based sourcing is in the orange. If we were to show you this map from 10 years ago, there would be a limited amount of orange on this map. So it's growing, it's getting there, it's where we're going. So let's make sure we plan for market-based sourcing. Our out-of-state tax burden will likely increase. Could be a good thing, could be a bad thing, depending on our state tax rates. Again, that's kind of what I just said, could be opportunity or detriment depending on the mix. We've got to have highly sophisticated accounting systems to track these different things different ways. There's definitely potential for cost savings, and we should always be, in the end, we've always got to be considering cost and benefit and exposure. See, are we comfortable with letting $40,000 from this project this one year sit out there so that we don't have to spend a couple of bucks and have to file every single year? So there's always got to be that cost-benefit discussion ahead. So what can we do? Kind of like sales and use tax, we can do exposure estimates, we can do apportionment review. We can check and make sure we're dealing with all those things right. We can help with accounting system setup. We've helped a few clients with that as well. We can help with audit defense. We've had a decent amount of merger and acquisition dealings this past year, so there's definitely opportunity there, and you got to think about that from the state perspective as well. We can deal with tax planning. We can also deal with corporate restructuring if it's going to save some tax dollars here and there. So the final piece I want to hit is credits and incentives. So credits and incentives are driven greatly by states and localities' tax policy objectives. They're very, very, very politically driven. Good thing, they're credits and incentives. They are things like the new business investment, increasing employment, encouraging research and development. There's definitely competition between states and localities to attract new business facilities, so that plays right into our favor. We can pit one against the other and say, hey, who's going to give us a more attractive property tax dealing or whatever. So there's opportunities out there for doing things. There's also a market to sell various credits out there. So just because, let's not assume just because we're experiencing some losses that there's not opportunities for credits. We can go out and we can find some things and go onto that market if they're transferable credits and transfer them and sell them off. Nearly every state, has credits and incentives, and it offers, they offer to attract new businesses. It's trying to make them attractive. And there's definitely something that we need to consider in the enterprise zones. There are areas that states or localities are trying to drive business. They tend to be distressed areas, so they're going to give you benefits for going into those areas. You're talking about income and franchise tax incentives. These tend to be in the form of investment and jobs credits. So R&D, big time, big example. There's state R&D opportunities out there all over the place. Sales and use tax incentives. You got certain property that can be exempt depending on the state's economy and industries. It's typically focused in the manufacturing arena, but there's materials and supplies used in construction. If it's used in enterprise zones, it's also an area of focus. And, it may take some initial thoughts in the planning process of any job to plan for this. So property tax incentives are typically focused on investment in enterprise zones or rehabilitating or rehabbing property. Again, a huge web of complexity. It's confusing, but there's tons of opportunity out there. So the big thing to drive home here is if you're planning to move, relocate, open a new branch, location, rehabilitate, renovate property, or if you're simply growing, there's a lot of credits out there, and let's talk. We can definitely ease the state and local tax burden that way. So as we can see, a lot of these things, state and local tax-wise, can have a pretty big impact on your bottom line, all of which tend to be extremely overlooked. Please refer back to our website for additional resources. They're out there, StanbulNest.com. And you can reach out to me to help plan or lessen your tax burden. Thanks for your time today, and we'll answer some questions for the next minute or so.
Do Nexus rules apply for architects working on an out-of-state project or on tribal land? And then personal unclaimed property. So it is best to let the unclaimed property alone or not claim it. And then another one is, you said states can end up double taxing the same income with different application of the sourcing of sales. How can that be? And I did answer, and I said we will try to get to all your questions. If they're not answered, Jason will reach out with the answers. Thank you for joining.
Okay, so related to that last question about double taxation, the way that they get around that is the individual state isn't double taxing. So it's not interfering with interstate commerce, is the presumption. Because of the complexity of the rules, you can have things that due to apportionment, if you add all of your apportionment percentages up, and if you're in all 50 states because of the complexity of the rules, you can end up at 120%. It's something that you got to plan for, and there's nothing wrong with it because they're all calculating it the same way. Now, there's typically in your home state or in some of those states, there's typically credits and things like that for taxes paid to those other states, so you should be able to get some of that back. But again, it just all depends on your mixture. It is confusing. It's definitely not it's tough to understand, but there is opportunity to be taxed more than once on that same dollar. And with that, I think we're going to wrap up for the day. Thanks everybody for attending.